If you own a healthcare clinic, a home health agency, or an assisted living facility, I need you to ask yourself one question. Is your accountant a tax strategist, or are they just a historian? A historian looks at what you already did last year, puts those numbers into boxes in April, and tells you how much you owe the IRS. They do not proactively plan your wealth. And because they are a generic generalist CPA who works with restaurants, plumbers, and retail stores, they are completely missing the massive industry-specific tax loopholes that exist only for healthcare businesses. Today, I am going to expose exactly how your generic CPA is costing your clinic thousands of dollars in missed deductions. Welcome back to the channel. I'm Larry Davis, EA, your Healthcare CFO. After serving in the Marine Corps, I built Tax Help to be the ultimate financial shield for healthcare owners. Today, we are talking about missed opportunities. I'm going to break down two highly specific tax codes, Section 44 and WOTC, that generic accountants completely ignore, and show you why you need a specialized healthcare strategist. Let's start with IRS Section 44, known as the Disabled Access Credit. As a healthcare clinic or an assisted living facility, you are constantly spending money to make your property ADA compliant. You install wheelchair ramps, widen doors, buy specialized patient lift equipment, or redesign restrooms. What does your generic CPA do with these expenses? They just classify them as a standard building improvement and take a slow, tiny depreciation deduction over 39 years. That is a massive financial failure. A tax deduction simply lowers your taxable income, but a tax credit is a dollar-for-dollar reduction of your actual tax bill. Under Section 44, if your healthcare business has less than $1 million in gross receipts or fewer than 30 full-time employees, you qualify for a massive tax credit for those exact same ADA upgrades. You can claim a 50% credit for eligible expenses up to $10,000. That means your generic CPA is literally throwing away $5,000 in pure dollar-for-dollar cash every single year because they don't know healthcare tax law. Now let's talk about payroll. Home health agencies and care homes have incredibly high employee turnover. You are constantly hiring new nurses, med techs, and caregivers. The IRS offers the Work Opportunity Tax Credit, or WOTC. If you hire someone from a targeted group like a qualified veteran, someone who was unemployed for a long period, or someone receiving government assistance, the IRS will give your business a tax credit of up to $9,600 per employee. Here is why your generic CPA misses this. WOTC requires IRS Form 8852 to be submitted within exactly 28 days of the employee's start date. Your generic accountant doesn't talk to you until tax season in April. By then, the 28-day window is closed forever. You cannot go back and claim it. If you hired 10 eligible caregivers this year, your accountant's lack of proactive communication just cost your agency up to $96,000 in pure tax credits. Let that sink in. You cannot build a multi-million-dollar healthcare business with an accountant who only looks in the rearview mirror. You need a CFO who looks through the windshield. You need a team that implements strategy in November so you don't overpay in April. If you are tired of generic advice and missed deductions, it is time to upgrade your financial team. Let my team at Tax Help audit your past returns and build a proactive tax strategy designed specifically for the healthcare industry. Click the link in the description to book a free strategy call with me today. Stop leaving your hard-earned profit on the table. Subscribe to the channel, hit the bell, and let's get to work.